Silver and gold aren't just moving today, they're announcing themselves. And if you've been watching this space for any length of time, you can feel it. Something deeper is shifting beneath the price action, beneath the headlines, beneath the so-called experts insisting this rally is exhausted. Because look at what's happening right now. Within the same 24-hour window, we're seeing fresh signals out of Japan, new developments out of China, a shockwave coming from Hong Kong, and an operational warning from one of the largest bullion businesses on the planet. When you line these stories up side by side, they don't look random, they look coordinated. They look like a pattern forming in real time. So let's slow this down and unpack what that pattern is, what it could mean for silver and gold in the next stretch, why so many people are still late to this move, and what matters next if you don't want to be reacting after the fact. Yes, prices matter, but the real story is why prices are behaving the way they are, because today, silver and gold are sending a message that's easy to miss if you are only glancing at a chart. Like when markets are calm, prices drift and everyone pretends nothing is wrong. But when stress enters the system, the small details start to scream. One of those details is the relationship between spot prices and futures prices. When the immediate price, the right now price, starts showing more strength than the forward price, that's not trivia, that's urgency. In metals, urgency is not a small word. You'll hear traders casually throw around terms like contango and backwardation as if they're just academic concepts. They're not. They read windows into whether the market feels comfortable about supply and delivery, or whether it's starting to get nervous. And silver is not a market where supply magically appears on command. You can pretend there's plenty right up until someone asks for delivery. I'm not here to promise a specific number on a specific date. That's not how real markets work. But I will say this, moments like this tend to show up before major moves, not after them. They're warning lights. And while that's unfolding, a second signal is even louder. The East is pricing metal differently than the West. This is where the old system starts to feel uncomfortable. For years, the world treated the paper, quote, as the price. But physical markets don't care about spreadsheets. They care about availability, delivery speed, and what it costs to actually remove metal from the system. When you see persistent premiums in major physical hubs, that's not noise. That's price discovery shifting away from paper. China matters here, not because it makes headlines, but because of scale. Scale of buyers, scale of manufacturing, scale of industrial demand, scale of capital that can move quickly when policy changes. The West has long treated precious metals as a niche hobby, but when industrial demand, household demand, and institutional interests start moving together, it stops being niche, it becomes infrastructure. Now, while people argue over whether silver is overbought, the more important question gets ignored. What if silver wasn't overbought at all? What if it was underpriced for years and is now being forced to catch up? That would explain why sell-offs don't behave like collapses. They behave like resets, shakeouts, attempts to throw weak hands overboard while pressure keeps building underneath. And this is where mainstream narratives start to sound strange. First, the move is ignored. Then it's mocked. Then it's explained away as temporary. And right before it becomes undeniable, suddenly everyone discovers reasons to be afraid. You're told the top is in, that smart money is leaving, that the rally is over. Meanwhile, physical metal keeps getting tighter. So let's zoom out, because the daily headlines are secondary. The macro forces are the engine. The first force is geopolitical fragmentation. Trade is no longer just trade, it's leverage. Currency is no longer just currency, it's a weapon. Supply chains are no longer about efficiency, they're about security. In that environment, trust becomes scarce. And when trust becomes scarce, anything that doesn't rely on trust starts to look valuable. That's why gold survives regimes. And that's why silver, when it's tight, can move like wildfire. Silver isn't just a precious metal, it's strategic material wearing a precious label. The second force is financial stress, especially in bonds. Here's the plain version. Rising bond yields aren't always bullish. Often, they're the market demanding compensation for discomfort. Falling bond prices usually mean someone is selling because they want out, need liquidity, or are being forced to reduce risk. So when bond volatility rises, while metals rise, that's not coincidence. That's options disappearing. For years, the playbook was simple. Stocks up, bonds protect, cash feels safe. That playbook made people lazy. It trained them to believe there would always be a bid underneath everything. But when stocks wobble, bonds wobble, and currencies wobble at the same time, the old playbook breaks. And when the old playbook breaks, people start searching for a new one. That search is happening now. Japan is a perfect case study. Decades of ultra-low rates turned its bond market into a global funding machine. Stability became habit. But stability isn't strength. It's often just delay. When yields start rising meaningfully, the math changes. Risk changes, capital flows change, and If the carry trade unwinds, it doesn't unwind gently, it rushes for the exit. When large pools of capital start questioning bond risk, they don't just rotate bonds. They ask a more fundamental question. What do I own that isn't someone else's promise? Gold isn't a promise. Silver isn't a promise. They don't require perfect policy execution to exist. At the same time, equities are weakening while metals stay firm. That matters. In past risk-off events, everything sold off together. Cash was king. But when metals hold while equities sag, it suggests something different. Not panic, but choice. Choices get powerful when safe options disappear. Real estate has cycles. Crypto is volatile. Stocks can be stretched. Bonds can wobble. Cash can be diluted. So where does money look when the room gets smaller? Often it looks toward the corner it ignored for years. That's metals. And this is where small numbers matter. Metals allocations are tiny, which means even a small shift can have an outsized price impact. You don't need everyone buying silver. You need a minority large enough to overwhelm a market that's already tight. Now add the institutional layer. Wealthy portfolios often have surprisingly little exposure to metals. So when an outlier makes a meaningful move, it's worth noticing, not because the wealthy are always right, but because they operate with different information sets and risk frameworks. When a major allocation appears, it often reflects concerns that aren't public yet. That's why reports of significant gold buying in Hong Kong matter. That's not vanity, that's worldview. It says something about confidence in paper assets. And when you compare that to how underallocated most large pools still are, the gap becomes obvious. The real question isn't whether gold is too high. It's how underallocated the world still is. Because underallocation plus fear turns into urgency. And urgency in a tight market doesn't negotiate. Hong Kong is also where human price discovery shows up early. Charts are abstract. Lines at dealers are not. When people line up for metal, the story moves from theory to behavior, from paper claims to physical ownership. In calm times, paper is fine. In stress, people want the thing itself. Now zoom out and connect the dots. Price strength, urgency signals, east-west premiums, Japan bond stress, equity weakness, high-profile allocations, dealer strain. This doesn't look like a tired top. It looks like a transition, a regime change, the moment a niche asset starts becoming necessary exposure. Markets don't need 1,000 reasons. Just one catalyst at the wrong moment. Policy shifts, bond events, currency volatility, industrial supply shocks, or momentum pulling in those who waited too long. Early in major moves, people mock. In the middle, they regret. Late, they chase. We're not in the chase phase yet. You can tell, most still treat metals as a curiosity. But the cracks are showing. One final point that gets overlooked: structural deficit. If consumption exceeds production year after year, inventories become the buffer. And when inventories shrink, markets become sensitive. Tight markets don't move smoothly, they move suddenly. That's why signals like spot strength, regional premiums, volume spikes, and operational strain matter. They're hints that the buffer is being tested. And don't fall into the narrative trap that says it's higher than last year, so it must be too late. That's psychology, not analysis. Prices can be higher and still early in a secular shift. Bull markets move in waves. The waves shake people out. The trend continues. Watch the drivers. Right now they're strengthening. And here's the part that surprises people most. Sentiment flips fast. For years, silver holders were mocked. That's fine. Mockery is cheap. But when the same people who mocked you suddenly want the same thing at the same time, markets get disorderly. Late arrivals don't arrive calmly. They arrive emotionally, and that emotion is what creates the strongest vertical moves. This isn't steady buying, it's urgent buying. Now let's be clear and responsible about that. This isn't a call for reckless decisions. No one can decide your situation for you. But it is important to understand the structure of the market you're watching, because silver is not an infinite digital asset that can be created on demand. Silver supply is constrained. Demand comes from many directions, and inventories matter. So the real question becomes simple but uncomfortable. What happens when demand grows faster than supply can respond? It doesn't mean everything explodes overnight, but it does mean the market has to rebalance. And the mechanism markets use to ration scarcity is price. That's not drama, that's economics. There is another layer to this that often gets overlooked: the idea that new access points can quietly change demand. When retirement systems, managed capital, or broader investment channels begin allowing exposure to metals, that's not just a policy discussion, it's a demand potential discussion. Even small allocations matter when the market is already tight. And then there was a more disruptive idea hovering in the background: tokenization backed by real metal. You don't have to love technology to understand what that could do. If a system emerges that allows people to hold metal-backed units frictionlessly, it could pull in participants who never would have touched coins or bars. That's not guaranteed, But in a tight market, possibilities themselves can move sentiment. So why does it feel like things are accelerating now? Because confirmations are stacking. Price action is confirming it. Physical behavior is confirming it. Macro stress is confirming it. Institutional signals are confirming it. When confirmations stack, confidence grows. Now, there's a trap people fall into at this stage, focusing on silver or gold instead of understanding how they interact. Gold is the monetary anchor. Silver is the hybrid. Gold moves like money. Silver moves like money and like a strategic commodity. That's why silver is more volatile. It lags, then sprints, it dips, then launches. So when gold pushes to new highs, it's not something to ignore. Gold often leads. Silver often follows with more intensity. That's why people watch the ratio, not because it's magical, but because it reflects relative value. When the ratio stretches, it can signal that silver is cheap relative to gold. And when silver is cheap relative to gold, catch-up moves can be violent. Now, let's talk about the idea of a perfect storm without turning it into hype. A perfect storm doesn't mean certainty. It means the environment favors a direction. Right now, that environment includes geopolitical fragmentation, bond stress, currency anxiety, industrial demand, physical tightness, potential policy shifts, and institutional underallocation. That's the storm. And that's why a rally can continue even when it feels like it already ran. Structural storms don't end because a chart looks stretched for a week. They end when the drivers reverse or a new equilibrium is found. And right now, those drivers don't look resolved. So what actually matters next? Watch the bond market. Not the headlines, the behavior, yields, volatility, auctions, confidence. When bonds get noisy, everything feels it. Watch physical premiums in key regions. If they stay elevated, demand isn't fleeting. Watch dealer behavior. When terms change, it's usually because flow is tightening. Watch how metals behave on equity down days. If they hold while stocks weaken, rotation is still active. Watch institutional language. Big shifts show up in words before they show up in allocations. Now, there's something that needs to be said about squeeze narratives. People love them because they imply fast outcomes. Real market dislocations aren't always clean. They can be slow, volatile, and emotionally exhausting. Tight markets don't guarantee straight lines. They demand respect. That said, tight markets with rising demand do create sharper price movements. Not because of conspiracy, but because of mechanics. Which brings us back to operational reality. When major dealers report record order counts and silver demand is growing faster than gold demand, that tells you something about accessibility. Silver becomes the entry point when gold prices rise. That increases volume, not just demand. And volume stresses mints, logistics, and production capacity. Those are real constraints. When bottlenecks form, delays appear. Delays increase urgency. Urgency feeds demand. That's how feedback loops begin. Now, zoom out again, because there's a psychological layer that often gets missed. Trust in narratives. When official narratives say everything is fine, while people feel rising costs, unstable policy, and uncertain futures, the narrative loses credibility. People start looking for alternatives. Gold and silver aren't just assets in those moments. They're symbols. They represent opting out, choosing something that doesn't require permission. That symbolic power matters during unstable periods. A quick word on miners. They can offer leverage, but they also carry operational, political, and cost risks. Physical metal is the foundation. Miners are optional exposure that require tighter risk control. And yes, it's still possible this move is early. Not because of optimism, but because allocations remain small. Because mainstream coverage still treats metals as fringe. Because public participation hasn't surged. Because bond stress isn't resolved. Because geopolitical fragmentation isn't resolved. Because physical signals keep appearing. That doesn't promise a straight line higher, but it does suggest the story isn't finished. One last practical distinction matters here. Timing versus positioning. Most people try to time perfectly. They wait for ideal entries, ideal pullbacks, ideal certainty. And often, they miss the move entirely. Positioning is different. It accepts uncertainty. It focuses on exposure to long-term drivers while managing risk through volatility. That mindset tends to survive better. Because eventually, every major move reaches the same moment. The crowd realizes the asset it dismissed is the asset it needs. And when that realization hits, price doesn't just reflect supply and demand, it reflects regret. Regret makes people chase. Regret makes premiums acceptable. Regret makes delays tolerable. And when regret enters a tight market, moves can become disorderly. Now add the currency layer, growing deficits, expanding debt, crisis management. Currency pressure doesn't always show up dramatically, but it accumulates. And when confidence weakens, hard assets tend to reprice. That repricing isn't mysterious. It's math, psychology, and trust intersecting. One final cliffhanger to leave you with. What happens if the West is forced to acknowledge that the East is setting the real physical price? If physical demand continues pulling supply at higher prices, paper pricing becomes less relevant. And when paper credibility weakens, systems don't collapse, they shift. If that shift accelerates, it would permanently change how silver and gold are viewed. Nothing here is guaranteed. But the pieces are clearly on the table. The key isn't fear, it's awareness. Understanding what the system is doing while it's still whispering before it starts shouting,